Hey, Steve Spretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I wanted to touch on a couple things here, little bit of homework pieces before we dive into this week's video. So first and foremost, the Soretsky report for January 2020 is now out. As I mentioned in last week's video, this report has been completely revamped. It's 37 pages of in-depth content, basically covering the entire Vancouver real estate landscape, whether you're interested in residential or whether you're interested in what's happening on the land development or pre-sales side. Basically, it covers all that. It has a little bit on the Canadian macro landscape again as well. So 37 pages of content there. There's going to be a link in the description below where you can actually go and read that report. So that'll be available to you. The second part is I have another Real Vision subscription to give away. Again, that is courtesy of our friend Victor. Again, I think this is his third one that he's given out now. So he's offered to basically subsidize someone's year subscription of Real Vision TV, which I think is important because this week on Real Vision, they are doing a 2-week segment on the coming retirement crisis. And that's something that I'm going to sort of touch on in this week's video. To go along with the last and third piece of homework is there is a report that came out from Artemis Capital Management, Chris Cole. Chris is one of the very well-respected sort of macro researchers. He actually put out a report on the whole short volatility thing before it blew up over a year ago. And highly respected guy. But he put out a piece called The Allegory of the Hawk and Serpent, How to Grow and Protect Wealth for 100 Years. And I think that this is extremely important because this channel is not necessarily just about Vancouver real estate and just talking about condos and what's happening with prices. It's really just about financial education. It's about having a conversation on sort of wealth creation and what's happening in the economy. It's just to have an overall understanding of things and just to sort of share ideas and have a dialogue. So usually what I do is I see reports that I really like I'll print this one out. I mean, this is like 50 pages. So I usually get, my assistant print it out and I'll read it. But I kind of want to read just a couple brief passages here that I think are really important because what I see, not just, I think Vancouver is just one sort of, small asset class, but you're seeing is basically this momentum trade, bias in financial markets. So basically the things that have done well in this bull market continue to do well because it's sort of created this recency bias, right? I mean, you can look at the stock market, you could look at things like Tesla, you could look at things like, again, Vancouver real estate or Toronto real estate for that matter, is that things that have done well in recent history has this sort of momentum trade that people are sort of extrapolating basically recent performance into the future. And again, nobody can predict the future, but I think it's important to go back and look at previous history and say, well, what is the 100-year historical return for this asset class? How has it performed over 100 years? Not just how has it performed over the last 5 years or 10 years or even 15 years for that matter. And again, I think it's important to sort of contextualize this because as he mentions in this report, all you have to do is go back and look at the financial history, and there's been periods of time in the stock market, in the real estate market, where some of these asset classes have gone 20 years with no real returns. Actually, in some cases, 20 years of negative returns. And in fact, in the 1930s, interest rates hit 0%. Central banks cut rates to 0, and central banks engaged in a form of quantitative easing back in the 30s, just prior to the Great Depression. In fact, if you go back and look, there was actually headlines that came out and said, new, quote unquote, new era of prosperity, how we have eradicated the business cycle. And so these things have all been said before, and I just find it very interesting because history tells you, I think it teaches you a lot of lessons. And so he puts this whole report together and talks about sort of the serpent and the hawk. And he basically says the allegory of the hawk and the serpent is a philosophical map to understanding the generational cycle of wealth creation, destruction, and rebirth to help guide your investment decisions and protect your prosperity. So basically she gives two sort of metaphors, and the first one is the serpent. And he says the serpent represents a period of secular growth fueled by virtuous cycle of value creation, rising asset prices. The growth cycle begins naturally through some combination of favorable demographics, technology, globalization, and economic prosperity. As the secular boom matures, it is eventually corrupted by greed, as fiat devaluation and debt expansion replace fundamentals as critical drivers of asset price gains, not unlike a serpent devouring its tail into oblivion. And then he goes on the flip side to explain the hawk. The hawk signifies the forces of secular change that will challenge and ultimately destroy the corrupted growth cycle of the serpent. The left wing of the hawk is the deflationary path, whereby an aging population leads to low inflation, faltering growth, a financial crash, and then eventually debt default. The right wing of the hawk represents inflation, fiat devaluation, and helicopter money. Neither path is mutually exclusive, and they often occur sequentially. The pattern is as old as money itself. And this really just goes to basically elaborate on something that I've been talking about ad nauseum, is that we can clearly see, what path that we're on. We can clearly see there is a massive devaluation, for the fiat currency. You can clearly see that there is massive debt accumulation that is not ultimately supported by an underlying fundamentals of the economy, right? I mean, you have basically 2%, sub 2% growth. It's actually, technically speaking, is the weakest recovery post-recession that we've had, I believe, in over 100 years, at least in the United States. So this is the weakest recovery, and this sort of low, at least by normal metrics, low inflation, aging demographics, debt expansion that is ultimately, again, not supported by the economic fundamentals. And I think it's just something to bear in mind, because you can clearly see this even in the Canadian, let's just dumb it down to the Canadian consumer. We just had the recent statistics come out, talk about, insolvencies were up 9.5% for the Canadian consumer. So work this backwards it was the single largest increase in the growth in insolvencies since 2008 and 2009. But you have to understand is that 2008, 2009 was the Great Recession. We had a financial crisis. So it makes sense that you would have seen insolvencies rise. But now you're seeing insolvencies rise in the Canadian consumer at a time when really financial conditions, they've probably never been easier. You have interest rates at 1.75% from the Bank of Canada. That's a negative real interest rate. You have a low unemployment. You have wage growth above 3%. So you have a sort of a strong labor market. You have ultimately negative interest rates, and you're seeing insolvencies rise. So I think that's kind of a red flag that it kind of just goes to show you that, the last time that we saw consumers start to default on their debt was in 08, 09. And not only that, but you can see that, again, despite the level of the interest rate being so low, is the debt servicing ratio in Canada is actually at all-time highs at 15%. The last time it hit this level, the last peak that we had in the debt service ratio was when the Bank of Canada over 10 years ago had interest rates at 4.5%. And now they're at 1.75. And again, I still think that there is a bias for the Bank of Canada to cut interest rates. Well, that will certainly help alleviate, potential insolvencies. But you can clearly see that if there was any sort of normalization in interest rates, you'd have massive, massive defaults. And that's kind of gets you going back to the hawk and the serpent, that you're kind of like a snake eating its own tail, where there's this massive debt expansion that is, again, not supported by this. And we're kind of just like is kind of just, society is basically almost eating itself. And so now we're entering into what I believe is a regime shift. Now, trying to time that regime shift is nearly impossible, but you're obviously entering that regime shift where, we have that, where the central banks are fighting those deflationary forces, and that debt expansion is obviously all going into asset prices. But at some point, you're starting to see, deficits don't matter, just print the money. Don't worry about it. We can't normalize interest rates, so we're just gonna have to print money and buy up, various asset classes to try to sort of keep the game going. And so that's something that I think about, even not just about real estate, but just preserving capital. Is that, I think again a lot of investors extrapolating, to being comfortable with a a negative return every month on your cash flow in an investment property, because you believe that you can extrapolate the recent price growth into time, that this will continue unabated. But again, as history shows us, there are decades and even multi-decades where certain asset classes do not rise. At least in real terms. Now, if you read the report, I encourage you to obviously do that. It does show that real estate historically has been one of the best performing asset classes. Obviously, the leverage helps with that. But again, there are times when real estate will, massively underperform. And of course, they advise to, that's when you go through these regime shifts, that's where things like gold ultimately play a large part in one's portfolio. So that's kind of what I was thinking about this week, just is, even talking about Real Vision, how they're having a retirement crisis series for the next 2 weeks. It's basically this massive underfunding in pension liabilities. Is you have really low interest rates that are creating this, fixed income returns are so low. So pension funds that are, depending on this are sort of, again, reaching for yield, basically, again, a snake eating its own tail. As he so eloquently, I'll just let Chris Cole take this away again. And he says, we are at the end of a 40-year demographic and debt supercycle. I don't think anyone would really argue that. I think that's pretty clear as day, that we've obviously accumulated a lot of debt, whether you're a corporation, a government, or a household. And obviously the demographics have certainly been better. We're an aging demographic, hence why Canada has to continuously boost their immigration targets. So he says, we're at the end of a 40-year demographic and debt supercycle, a snake devouring its tail in a diminishing search for yield. So you can see, not just the consumers, but the pension funds reaching for yield. They're entering into more and more risky asset classes in order to get the yield that they need to ultimately fund these pension liabilities as this demographic ages. And what is ultimately, unfortunately, is the reality is that a lot of these pensions are not going to be able to meet those liabilities. And so people that were retiring and expecting their pensions to fully be there, they will be devalued either through a currency devaluation, through inflation, or simply a debt default. So they'll simply have to default. I think that's probably the least comfortable way to do it. They probably won't do that. They'll probably go through the devaluation phase, or you have to get some sort of mechanism where central banks, again, try to intervene to purchase the assets. And ultimately, they're saying that there could be policies discussed that put a stop on certain banks and certain investment funds from actually being able to hit the sell button. And so I think that we're certainly reaching pivotal moments in financial history that I think, again, all investors, as it pertains to this channel, Canadian housing investors need to be cognizant of. I think that's kind of what I am focused on this week. So I'd highly encourage you to check that out. I guess all I can say is to sort of wrap it up is, check out the link below to not only my 37-page report, but also to the report here from Chris Cole. And lastly, again, if you want that Real Vision subscription, put a comment below and just let me know why you want it, why you should get it, and I'll just pick one random person. So I hope that video brought you some value. If it did, please hit the thumbs up button and subscribe. See you next week.